Hello there, everyone, and welcome to this special presentation titled Prepare to Go Bottom Fishing. My name is Steve Chappell, the Director of Trading Systems Development here at VectorVest, and boy, this is a subject matter near and dear to my heart. I first learned about it, of course, through Dr. Bart DeLito, went out on the road over the past 20 years really teaching this whole concept together. And, it's something that's absolutely been a big part of changing my life. So I'm hopeful that today's content can be that impactful, for each of you. Bottom fishing is a crucial strategy. It's a crucial part of any investor's toolkit once you understand it correctly. When executed correctly, it stands as one of the safest, most reliable, and even highly profitable trading decisions you can make in the stock market. So the key thing is that it's my job at this point to help you undergo a shift. And boy, old Stephen Covey, the paradigm shift, right? We got to out with the old, in with the new way of thinking. And yeah, it's going to kind of turn things on its head a bit for some of you. Just realize that we're going to be capitalizing on very unique opportunities in the stock market that come very seldom, but when they do, they can change your life. So let's get into it. What we're going to be teaching here is how to go from buying safe, undervalued stocks rising in price. These are the kind of stocks that really click along and do the best, most assured returns in mature market rallies and times when the stock market is humming along. This is exactly where you want to be. But when markets go on substantial declines, dare I say even bear markets are going to create even more opportunity in this realm of what we call bottom fishing. We're going to move from those safe, undervalued stocks rising in price to stocks that have really come down the page the most, the stocks that have been just clobbered, beaten, silly, but that still have some pretty decent fundamentals. And we're going to watch those stocks explode in price when we are able to identify and nail a market bottom. Because, hey, these stocks got clobbered and they have some growth, they have some potential. They can absolutely fly up the page to the tune of 50, 100, 200, sometimes even 300% or more, and not in years, mind you. We're talking in weeks to months. And so it can totally change your performance in any given year when you get this right. Even if, and I do suggest doing this with a smaller denomination of capital than, say, your retirement account. You can break off a smaller chunk, 25 or 50,000 or whatever the small chunk number is for you, and you'd be surprised what that small chunk number can do in terms of ramping up your performance on any given year. So what we're talking about here, guys, is bottom fishing is the art of buying stocks ready to explode in price when the stock market has hit a major bottom, or even just an ordinary bottom in general. But boy, when you get the major ones, that's when it really gets fun. So this is the very essence of buying low and selling high that we've tried to teach our subscribers over and over and over again. And in particular, as it relates to this, boy, you can see those explosive returns buying them low and selling them high. All right, so let's start to define. It's really a two-prong attack here, at least in the very essence of it, and that is market timing, and that is the paramount decision. That's the one of the utmost importance, most critical decision that you're going to make, because it's going to dictate the outcome big time. And so we need to learn how to identify a potential market bottom to get prepared for what we term the blastoff day. Now, in order to start looking for a blastoff day, we have a couple of indicators listed on this slide. One, which is a requirement, is that the BSR has to be less than 0.2 to be willing to take this approach. In other words, stocks need to be bloody enough to where you're going to get some really good ones that have been beaten up. And catch the spirit of the slide here in terms of 0.1 is even more significant than 0.2, and by orders of magnitude typically, and 0.02 is even better than 0.1. So the lower the better. It's like stretching a rubber band. The lower these indicators go, the more potential on the ensuing rebound off of that bottom. Now, the MTI, not a requirement. It's nice to have an MTI go below 0.6. We find that those typically equate to even stronger bottoming situations. And here again, just top of my head, I've seen an MTI of 0.34, for example, and that's a lot lower than 0.6, right? And that bottom was far more significant than a lot of the more recent bottoms, that we've had here in the stock market. So the lower the better, guys. Can't drive that. And that should be in terms of even your expectation on the performance in your portfolio after you execute it, right? So I'm not going to expect as much out of that portfolio at a score of 0.19 as I am at 0.06. I'm expecting much bigger returns at 0.06 on the BSR. Make sense? Hopefully so. So let's go take a look. I can show that to you visually on the charts. So what we're going to do is we're going to take a look at the market timing graph. You know what? So we're going to go to the timing tab, market timing graph, get in here. And first, let's just take a look at where we are now. So we've had a pretty decent pullback here so far. Now, not enough to get us into bottom fishing territory just yet. That PCE number came in this morning a little bit better than expected, and that's given some hope to some investors that are trying to drive prices higher here again. Okay. Had that number gone the other way and come in a little hotter than expected, we very well would be into bottom fishing territory here already. But that's important observation to make, because you don't want to go about this technique until we get to the thresholds that we stated. And 0.23 is not below 0.2. And there is a difference. And remember, it may not sound like much, but there's a great deal of stretching on these stocks between those two numbers. Okay. Just like 0.1 is better than 0.2. Okay. So it's got to get below 0.2. It's not yet. So I'm hopeful that for this to be timely anyway, that maybe there's some more downside to go before we really heat up. And there might be. We've had 3 pretty significant down days, at least in aggregate, prior to today. So could be some dead cat bounce. We'll see, right? But certainly wouldn't be trying to quantify this as a bottom just yet. More so just kind of normal market action. All right, so with that in mind, we'll go back here a little bit, and we'll pay close attention to the BSR here in particular, because this is the one that's the requirement, right? So if we just kind of go back and visually look at around a level of 0.2, we don't really see any. We can verify that. Get my date line. Buy-sell ratio right here is 0.17, okay? And this was sort of a quick little, almost flash crash type thing over those 3 ugly days in August of this year. But look at how the market snapped back and the run that it went on from that level. So you can already see that there's some value here, and that's off a mere level of 0.17. Let's go back. Now look at the run. That's pretty strong, right? But there's a lot of ebbs and flows to it in order to get all the way to where it ultimately peaked. If we go back here, look at the buy-sell ratio now, 0.09. So even more pain in the stock market before it got going. And look at the price action as a result. Sharper, steadier, swifter, stronger magnitude, all of that, right? And so, yeah, you actually get into a situation here where you start licking your chops in VectorVest as the market keeps going to lower, because you're going to get an opportunity of a lifetime, the bloodier it gets. And so, for example, if we go all the way back, I got to keep going, my goodness. We go all the way back here and we look, you were running a buy-sell ratio level at this point at 0.02. That's as low as it can go. We know that now for sure. But look at how much pain that was and how quickly, and then look at the snapback and look what continued to happen from there. See that? So again, it's like stretching a rubber band. The lower that number goes, the better the bottom is going to be. And it's typically going to be faster, swifter, more magnitude, and longer on that rebound. You with me? Okay, so that's the first part of the coaching. So, man, you get something below 0.1, you really start licking your chops. See what I mean? All right, so with that behind us, I can start putting some numbers to it for you so you can see that, because this is just the first part. Now, before I leave, I think it's important to mention something hugely important, actually. When we get down into this level, you don't just buy stocks because you're down below 0.2. remember there was a blastoff indication. We need to have a day where the market leaves some pricing, recent price bars in the market behind. You know it. We need a day where this market, you know for sure, when you're blasting off, you feel like the dumbest thing you could do is not buy some stocks that day. You know, I can remember 2009 in March when I woke up and I saw the Russell up 5%, the S&P up 4%, the Dow up 3%, and just the pre-market. You know, I was like, I got to get to work, so I got to pick some bottom fishing stocks. You know, and those stocks, absolutely. That was when Citigroup announced they turned a profit first quarter of 2009, took the whole market. So a lot of times these really life-changing bottom fishing opportunities are off of a catalyst that the market doesn't even expect. You know. But you can see it, you can feel it. And when you're watching stocks in the stock market that day, some stocks were up 20, a lot of stocks were up 15, 20, 25%, not just a few. I mean, a lot of stocks were, right? So you know you're on a bottom then. So you got to use some judgment. There's no way to perfectly quantify it. We've tried to come up with a solution there for years. But you know, about the best way to dictate it to you, come back here a little bit more recent. You know, this isn't a blast off day. You know it ended up being an up day, pretty good change in sentiment at the open, but not a lot of bang from there, right? But it did produce a reversal pattern known as a bullish harami, right? So you can then use that intelligence and say, all right, I'm going to wait one more day here. And if I was still a little bit uncertain that day, you know, you can wait an extra day or two just to make sure that the market looks like it's bottoming. It's going to leave those low prices behind you. Okay. We try to do a good job at help coaching people up through the color guard reports and things like that when opportunity presents itself. So be mindful of that too. Might be a good day to tune into a color guard report when you have questions. Are you on a blast off day or not? Okay. All right. So there's that. And boy, if you weren't sure until here, now you're pretty well darn sure, right? So about the longest you ever want to wait. Otherwise, you might as well just go out and buy VectorVest traditional stocks. You're snapping back so much, you know, that you don't want to give all that great opportunity away. This was a primary wave confirmation day off of a low. And you can see, you know, sometimes you might get a little tripped up if you're not careful. So waiting for something like this and follow through the next day could be a good recipe for folks that try to go about this. And the other thing to remember is, if somehow you ever get, you know, kind of snookered into a signal where the market ultimately in 3 or 4 days starts to go lower again, you know, you're going to shut down the campaign and you're going to wait for it to hit that next low water mark and do it again. Why? Because any pain that you might have encountered here, bam, you know, it's going to evaporate it. You're not even going to worry about it ever again. So because it's stretching that rubber band, you know it. It's just, the more it stretches, the better the rebound. So sometimes you got to take a quick lump, move on to the next before the big one hits. That does happen. I think it's important to point that out. All right. So we've got some rules and things we're going to talk about towards the end that really help you along in that regard. All right. Now with all of that, let's talk some performance. I mean, I think let's set the stage with the granddaddy of them all, just to show you what's really possible should we have a correction at some point in the future of these kinds of magnitudes. You know, market came down, boom, hit a bottom here on March the 23rd, and then boy, took off on the 24th, right? So we would have to be doing our homework each of these nights as the BSR is down here. And then we're just waiting for that day that looks like it's going to leave things behind. Like this wasn't a blast off day. That's not a blast off day. These are potential setups for the next day. You know, but when you start taking out 1, 2, 3 and 4 opens and closes from prior days, you know, market's made up its mind. You know, so at some point that day would have been a good day to buy stocks. With me? 324. Now, if we would be running our homework in VectorVest with searches from the night of 323. So just keep that in mind. All right, so what I'm going to do is go back in here because this is the real key on the stock level. If you want to find the ones that are going to explode, that are going to go up like that Helix Energy, which was actually a stock that I did back in a number of years back, 2018, I think it was. But anyway, low RT is the key. You want to identify stocks that are hitting bottom when the market has bottomed. And typically, the lower the RT, the better. And that's how the scans are formulated. The lowest RTs go to the top of the list. So that's different, right? And what it's going to do is going to put cell recommendations up there, because the RT levels are going to be 0.01 or 0.05 or 0.1 at times. They're going to be really low because you're buying the blood. So they're going to be cell recommended. Now, you don't do this on a confirmed up call. Although you can get away with it sometimes, that doesn't make any sense, okay? We're trying to take advantage of a certain situation. Favor stocks with higher RV ratings to avoid buying complete garbage. It doesn't mean they have to be 1.5 or 1.6, but having a little bit of relative value, a little bit of growth engine on the stocks, I think it can certainly give you a little bit more peace of mind, and often does lead to better returns. One particular trade over another, it's hard to say that, but thousands of trades, high RV does seem to matter. All right, so let's move on from there and over into the search directory in VectorVest. So we'll go to Unisearch, right? And in there, let me go back here. Let's start the granddaddy of them all. Well, most recently. Granddaddy's really still 2009, maybe, although 2020-21 did change my life, no doubt about it. But let's go back here. Let's go to March, and it was the 23rd, right? The night of the 23rd, we still could have been doing our homework. And let's just take this S&P search that's selected, but I'm going to show you a few, okay? This is kind of middle of the road. You want to know the truth? On terms of it's not as risky as some, and you're probably not going to get as good of juicy returns as some. It's right, kind of, remember Goldilocks and the Three Bears? It's kind of like the porridge is just right, for some. Let's see. Let's quick test it. Now, this is all the way to now. Let's take this back here, or pretty close to now anyway. Let's take this back, because we said days to weeks to months, not years, right? So let's go back. We're going to go back to 2020. Let's say, when did we get a C down? Let's just take it up to September 11. Bang, 65% with S&P stocks, and it's beating the S&P stocks in general. And we did have a position that we probably could have managed out and maybe even done a little bit better. Let's go back a little bit though, because I find they start to lose a little bit of momentum typically after the first couple months, because they've already snapped back to where they should, right? So let's just go back here a little bit. Let's say end of June, for example. All right, so 33%. Just by June. Now, that's that particular one. Let's go to the granddaddy of them all. Dr. Delito used to call this the mother of bottom fishing searches. So this is Jailbreak. You're going to see here, now it's not S&P 500 caliber stocks. You're going to have some $1, $2, $3, $6, $4 stocks in here. Look at the RT values, 0.001, 0.001, 0.001, 0.001. I mean, that's you think do you think those rubber bands might snap? You think they might snap back pretty hard? Look at the RV on some of these at that point. 2? I don't know if I've ever seen that before. 158. Wow. All right, let's quick test them. Look at that. Look at that SSL that had an RV at 2 at that point. See that? Biggest returns on the page. Now that's not always going to be the case. What people are doing is they're just buying up this blood. But man, look at that. 176%. My goodness gracious. In just 3 months. Okay. You think that might change your life a little bit? All right. Well, Steve, y'all are crazy, man. What are you doing? All right. You go blue chips. You go Lennar and Delta Airlines and Citi. You're still buying up the blood. Okay, look at the RTs here. 0.1, 0.13, 0.14. That's about as low as those ever go, Well, now we do know, actually. If we go to quick test, boom, 6 double market performance. You know what I mean? So this is, and then once you get 3 months in, you're better off just going right back to your Mag 7 and your top VST and your top RS, kinds of stocks again. Because the performance is going to start to level out, and you might as well be in the better stocks at that point, the superior stocks. So typically, how I like to manage these is, and how we teach it in our course, is when you take a profit or a loss on one of these, you just cut it out and keep what's left, and you start reducing your risk as the weeks go by, when you sell something, you just don't replace it, because when you get that confirmed up call or the first green light, whatever your methodology might be, that's when you're going to want to buy those better quality stocks anyway. So you start transitioning your basket of holdings that way. Hopefully that makes sense to you. Okay. You want to de-risk it and get the better quality in there as you go. You might replace them if you're replacing them in like the first week or something, particularly off a major set of numbers that are really low. But after that, you just kind of want to start working your risk off. All right. So hopefully all of that makes sense. Now look, everybody's going to say, all right, what's your favorite? Well, I got to be honest, this one's been pretty good as of late. Let's see how well it did off of 2020. I like to go with what's hot, Lately, this one's been a tough one to bet against. Over 2022, I think it was our top performer when we did it, and that was a tough year, But yeah, it's just very, very, very steady, and it makes a lot of sense because you're looking for these stocks that have been killed that are in rising industries at the time that you're running the search as well. So these are industries that are on the move too. So you got market moving, industry moving, stock moving, and so if we come to a more recent bottom, time's already getting by me here pretty quick. Boy, I tell you, I need 5 hours to really set it in stone. But I think you're going to know enough. I think you're going to get it. Let's go. I think it was October 30. Memory serves correctly. We'll look at the chart here in a second. Let's just run it up here and take it back a little ways. Okay. So we'll go to we'll go to the confirmed up call, just like I told you, more than doubled market, S&P performance. Look at that. Not a loser in the bunch, and look, if for some reason, that's one where maybe the prices are still a little low for you, something like that. You just go back up here, the best of the biggies. Bang. Not quite as strong, right? And that's because the prices aren't quite as low. Those two things tend to go in unison. If you're somebody that, I know a couple of them here in VectorVest, you're somebody who wants to throw caution to the wind, you can get down here in these $1 and $3 dollar stocks. Watch what happens. Bang, But the other message is, boy, with a little bit of common sense, and we'll give you some common sense here in a second, these results would have been even better. So let's get back into the slides. Hopefully that's enough for you to see it. Now, I said 10:30. You guys are probably wondering. Let me just make sure I solidify the 10:30. Okay. 10:30 was right. Which one was it? Oh yeah, because we were coming off a pretty good correction here. Best one we've had most recently. And this was a situation, MTI got down there. Let me show you. 0.5, so that's well below 0.6, right? And buy-sell ratio 0.08, so not quite to the COVID lows, So we can't expect that. And remember, 0.02 is magnitudes better than even 0.08, okay? Now, but boom, shot on up there. And had we done the tests all the way to December, we'd have done even better. But hopefully that's now solidifying all this for you, okay? Now that would have been a pretty aggressive approach here. So if you wanted to wait a few days, you can see what happens there. Let's go back to Unisearch. See, I'll just never stop. I'll just keep going because I want people to really understand it. What if we waited a day? All right. Well, we didn't give away too much there, did we? So that's good. We waited an extra day to be more sure. Would have bought the day following the 31st on that one. What if we would have waited and followed November 1st instead? Even more sure. Now you're giving away some of that profit potential. See what I mean? So you don't want to wait too long. That's the key. So another great thing to consider is looking for those candlestick reversal patterns. So if I go back to the chart here really quick, this was a bullish Harami with confirmation as of 10/31, and we still could have clipped 22% on that quick 1 month, waiting for a logical reversal pattern indicating a bottom could be in place. And really didn't even have the explosive day here that we would prefer to see. So sometimes that'll happen, and at that point, market's reversing for a few days, and you're starting to get some patterns and things. That's when you want to pull the trigger. All right. let's get back into the slides. And also know, in the daily color guide reports, we're going to be helping people with that. So make sure you tune in, and we'll be putting some commentary on that, or better be. If they don't, you let me know. Trading tactics that help you make you money. 5 to 10 stocks per campaign. I would strongly suggest 10 when you start. You just saw in some of those results. Just think about the results you saw. There were 3 or 4 stocks in some of those that didn't do very well. You don't want to land on the wrong 3. You want to land on the right 7 with as much possibility as you can, right? So 10's good. 5 can do better when you get them all right. But I wouldn't go any less than 5. Wouldn't go any more than 10. I mean, you're starting to get into a mutual fund. Never risk more than 1 to 2% of the total portfolio value in any single trade. So that I would say even in the situation, $1 million account, I'm only going to do it with $100,000 or $50,000 or whatever. I would do it 1 to 2% of that $50,000, not the million. Keep risk small, because the ones that run should really run. See what I mean? Go to number 3, favor wide stops, because these things are going to be volatile. Our experience is anything closer than 15% can be problematic. And profit locker, 1550 is a pretty good combination on the shallower numbers, meaning closer to the 0.2, closer to the 0.6. 99.15 works really well. The lower, below, like 0.1 and below, typically, you start looking for more upside, right? Just like we told you. Make sense? But 15 is kind of the sweet spot on the low side of the risk management spectrum for the initial stop. If you get out more than 15, odds are it's probably not going to get going. Make sense? All right, number 4, allow your portfolio to extinguish itself by not replacing stocks that hit your stop loss. Definitely after the first week or so. Because one of 2 things is likely happening. You're ultimately going to go to a lower low in the stock market because it hasn't taken off like a bird yet, right? And if you wait too long and the market is ripping, and markets have already moved a lot at that point, and so you have a little bit less potential with each one of these as time goes by. And you saw quite dramatically at times with the testing I showed you, right? So that's it, guys. That's it. That's all you got to do. Look, let's take one last peek at the market here. I know some of you might be thinking explosive day to day. Not so much, And now it's getting by the time the day's done, we'll have to see here. But the reality is, we didn't get down to the levels we needed to with the buy to sell ratio. So, unfortunately, 0.23, it's not close enough. They're not stretched enough. You'd be better off just kind of going about business as normal here, waiting for a green light in the price column if we don't go any lower. Now, if we do, and we do go below 0.2, and the lower the better, then we can start looking at this methodology from today. So we were lining this up, looked for a moment there like we might absolutely nail this for you. Well, if the market reverses here, we tried. We tried to nail it. So this happens sometimes. We'll see how it goes from here. So stay tuned to that color guard report next week, and we'll keep you dialed in and make sure you know what's what. Okay. Thanks for tuning in, guys. See you soon.